All right, friends. So welcome to this segment. We are looking at subsequent events and going concern. As auditors, what should we do when it comes to issues of subsequent events and then going concern? What do we mean by subsequent events? So, at the financial year of the client, maybe 31st December and 2021, okay, 2021, yes. From that year end until the time when we sign the account, and many things can change. Many things can change. Sometimes, accounts could be signed 6 months after the year end, 3 months after the year end. A lot of things could happen. You are actually eating into almost half year of the subsequent year. Okay. So what happens when some events occur? Events which could one way or the other affect transactions in the past, in the previous year. So we'll be looking at ISA 560 subsequent events. And it also reminds us of IAS 10, okay, the National Accounting Standards 10, which also deals with post-balance sheet period events, transactions which occur after the balance sheet period or the statement of financial position period. And again, the same two key items which come in adjusting events and non-adjusting events. So we'll look at this briefly and then we'll wrap it up. Once again, my good friends, this is a summary. So would expect you that in your own time, you make time to read as much as you can from the text. You can find this on page 364, okay, onwards, or chapter 23 of the core text. So that should be it. All right, let's proceed. So what do we mean by subsequent events? I briefly explained. We'll look at difference between adjusting and non-adjusting events. The same understanding from IAS 10, your financial accounting theory, should be the same thing here. Nothing changes much, but we'll look at it from the perspective or the lens of an auditor. What should we do? What kind of work should we carry out as auditors when it comes to subsequent events and going concern issues? What are the roles the directors need to play when it comes to subsequent events and going concern issues? What are the implications to us as auditors on our report on issues of going concern? Audit reports will always have a paragraph or some narrative reporting on the going concern issues of the company. And then explain, I'll leave the last one, explain the particular problems with smaller entities. I'll leave that one. You read that one, okay? You study that one. So it is, we're not spoon feeding you with everything. We expect you to do some independent studies, okay, on some of the areas. All right, I'll leave that one. So like I said, year-end subsequent events, ISA 560 occurs between the year-end and the date we sign the accounts. So two events, adjusting and non-adjusting. When we talk of adjusting events, they are those events which provide additional, extra amount of evidence to us about something which existed at the balance sheet date. Okay, not after the balance sheet date. We are talking of the balance sheet date. So any event, additional evidence that this thing actually occurred, it applies to the balance sheet date. Then we have to go and adjust it. But the non-adjusting events are those events which arise after the balance sheet date. Now, they could be very material and significant in nature. We don't have to adjust it. We disclose. We disclose it. At the end of the day, remember, all that you are doing is to help somebody who will leverage on your report, make an informed decision. So even though this activity occurred in the subsequent period, and it doesn't apply to the balance sheet of the year, the date of the balance sheet which you are auditing, since it's material and significant, just disclose it, okay? But if it applies to that year, of course, we have to adjust it, okay? So specific inquiries you are supposed to make under ISA 560 ask whether there are new commitments, there are new loans which have been borrowed, which have been entered into any loan covenants or guarantees which the company has entered into. Also probe into whether there have been sales and acquisitions of any assets. Could be inventory, it could be PPE, okay? Whether these have occurred or they are planned, and when did they occur. It is always important to look at the cutoff dates. Always important to look at the cutoff date when you're looking at ISA 560 or IAS 10. Always look at the cutoff date. The clients could be very cunning. They could be very cunning and tricky. That's why normally you see that when the year is ending, they pass a lot of adjustments. And at the end of the year, immediately they reverse those adjustments. So be careful of cutoff dates and be careful of dates, okay? Also ask whether there's been any increases in their share capital or debt instruments, any new loans, any agreements they've gone into, long-term loans actually. Also ask whether there's been any assets which have been confiscated or taken over by the government, any assets which have been destroyed by fire, by flood. Ask yourself and get evidence of those items. Ask whether there's been any development regarding contingent assets or contingent liabilities. What does it entail? Is it a litigation issue? Is it something we're expecting insurance payouts to us? Okay, just look at all of these contingencies and also check whether there's been any unusual accounting adjustment that have been made. And that is why I'm saying you normally check those special journals that are used to pass some transactions, some adjustment at the end of the year, to post some transactions, and immediately at the end of the year, they will reverse it. Also consider whether any events have occurred or are likely to occur that will bring into question whether the accounting policies used in preparing the financial statements are appropriate or not. Ask yourself, okay? And also ask yourself whether, or probe with a client, whether any events have occurred that are relevant to the measurement of estimates and provisions made by management in the financial statement. They use judgments. So on what basis are they making these estimates and how did they measure it? Also ask whether any events have occurred that are relevant to the recoverability of any assets. Probe all of these. Now, examples of adjusting events, the list is not exhaustive, okay? Probe further, read more research into this, and you can get more examples of events which are examples of adjusting events. So, example like allowances for obsolete inventory or bad debt. And of course, look at the cutoff date. Look at the cutoff date. Amounts receivable under insurance claims under discussion at the balance sheet date. At the balance sheet date, okay? Any settlement of legal cases after the balance sheet date. Yes, they settled the legal case with some compensations paid after the balance sheet date. But to which period does it occur? Previous period or the new year? Okay? If it relates to the previous period, you got to adjust it. Some events take place after balance sheet date, but they are not shown in the accounts. Okay, dividend payments, tax adjustment by the tax authorities. So take note of those ones and ask yourself, should I adjust it? Once they apply to the balance sheet date, you adjust it. But the non-adjusting events like the issue new capital after the year end, that's a new period, okay? Major restructuring, reconstruction of a group or restructuring of a company, significant acquisitions and mergers, change in the nature of business, loss of assets after flood or fire, any strikes, any nationalization issues, legal prohibitions. These are normally significant material, but since they don't refer to the balance sheet date, check the dates, check the cutoffs. You have to disclose them in the books. What do we do as auditors when it comes to these subsequent events to determine whether they should be adjusted or not? As a first point of call, talk to the management, speak to them, obtain all representations clearly written from the directors provided to you in written formats of any subsequent events that may have occurred. Obtain any minutes, board meeting minutes, any other minutes of any meetings, and keep them on file. Review them. Also review management procedures on how they are able to identify subsequent events and use that possibly as a starting point. And of course, ask management, talk to them. How did it occur? What occurred? Tell us what happened. Give us the details. They will normally have budgets and forecasts. When you take the budget and the forecast, within the budget, you would have seen maybe these guys have provided a forecast for litigation to be paid. Why is it happening? Why are they putting in legal compensation here? To who? So you take the budget and the budget narrative. If they have a detailed implementation plan, DIP, or where in some cases you see they have what they call log frame. Take that log frame, that detailed implementation plan, those narratives that accompany the numbers, the forecast, and it will tell you why they are making those forecasts and those budgets. Again, verify year-end balances by normal audit work. Use your normal audit work, okay? Send bank confirmation letters to the banks and ask them to confirm their account balance at the end of the year. Send reconciliation. Yeah, you can reconcile the debtors, the suppliers' statements to what you have on file. You can send debtors secularization. For trade debtors to confirm the balances they owe the company, you can also send secularization to the debtors as well, to check to the suppliers, okay, to the vendors as well, to check what amount the company owed them and reconcile, okay, reconcile. Now, if adjusting events arise after the date we have signed the accounts, and either before or the accounts are issued, so we have signed accounts, but before the accounts are published, issued into the public domain, what if something happened between that period? You've signed accounts. What happens? Review that event which has occurred, gather evidence about it. Now, ask the manager, how do you intend to deal with this, especially if it is material? And of course, if it's material as an auditor, take a step to reissue new sets of reports. You will surely have the old report, 2 reports, the old report with the old date when you signed off, and a new or amended report with a new date you signed off to show that, oh, I signed it on 30th May 2022, but something happened between 30th May and 31st or 30th June. Something happened in between. So I have 2 sets of reports, the originally signed and then the amended one. Now, if accounts are not amended and they are not reissued, but they still stick to the old report, and the matters which has actually arisen between the time when you signed and the time that they issued it is material, you could take legal action or report this at the shareholders meeting, at the annual general meeting. Okay, so you must always take steps to avoid any auditor liabilities. Reputational risk, you don't want that one to occur to your organization. Now, auditors may have to take steps to avoid reliance on the audit report on sets of accounts which proves to be incorrect. So if I have any report and if subsequent events may have rendered my report incorrect, I must take steps to avoid that. Okay, I must take steps so that people will not rely on that report which has been issued, which ideally should have been amended or I have amended it, but the client has decided not to reissue a new report. You know, it's costly to issue one report and to issue another report. So sometimes they'll go with only the initial one. But of course, the best is at least to have the amended one, and it must show the changes which have occurred. A subsequent event review should include consideration of current profits and expected profits. Look at their budgets. It will tell you expected profits and what they projected. Should also consider debt repayments, where we have additional funding coming into the company. Now, it is for the directors to tell us as auditors that, listen, our company is solvent, we can survive into the foreseeable future period. And they must provide evidence to the auditors to that effect. They don't just say it, they don't just write it, they must prove to us that our company can survive. It's solvent, it's not insolvent. We are not going to liquidation. So here, the issue of going concern comes in. Okay, the issue of going concern comes in. Now, if I have reviewed the company's financials and I see any indication of insolvency, I need to raise it up. I need to consider it as an auditor. And I need to report on it. That's why the audit report has a whole section on going concern. So ISA 570 talks of going concern. It says, as an auditor, we must gather sufficient appropriate audit evidence regarding going concern, and we must conclude on whether there is any material uncertainty regarding the going concern issues of the company. Is there any material uncertainty relating to going concern? I must also gather sufficient appropriate evidence regarding how appropriate the management use of going concern basis of accounting is ideal in the preparation of the accounts. So auditors, management will usually prepare the accounts on the basis that the company will continue on into the foreseeable future period. For me as an auditor, I need to assess the basis upon which management is preparing that account, the accounting basis upon which they are thinking that the company will survive the test of time. So how appropriate is their basis, their justification? Now, these responsibilities we've been told exist even if the financial reporting framework used in the preparation of these financials does not include an explicit requirement for management to make a specific assessment of the entity's ability to continue as a going concern. So if the IFRS we are using, the country-specific gaps, do not have a provision for you to make a basis upon which you think your company will continue into the foreseeable future. The accounting framework doesn't provide for it. Even if it doesn't provide for it, we as an auditor must verify the basis and appropriateness of the basis on which management is thinking that their financials are prepared in line with the idea that it will continue into the foreseeable future. So ISA 570 tells us, in terms of going concern, that management must at least give, it is their responsibility to ensure the company survives into the foreseeable future period. And they must give evidence of at least the company being able to survive for the next 12 months. Okay, minimum 12 months, they must give that evidence. So as auditors, who would then have to review the financial statements in light of any events arising from the audit, and also review the financial statement in the period between the year end and the date we sign the accounts. So these guys have assured us company will survive. They've given us basis. They've given us information, evidence to support it. I will have to review it as part of my work. And also between the time when the company year ended and the time I audited, I need to check whether their going concern basis is ideal and appropriate. There are some underlying assumptions for going concern, and one says that management should be able to influence the way the business is run. The product and services that we sell will continue to be sold to a broad range of customers, not even the same customers, maybe different additional customers. Again, our suppliers whom we rely on for raw materials will give us the inputs. They will not cut us off. We must always have cash in the business to run operations. And cash is the most underlying item there because, listen, in the human body, what keeps us going? Blood. Blood. In the business, what is the blood, the lifeblood of the company? Cash. Cash. So check if they don't have cash. I was once examining the financials of Tesco. They were making a lot of profits, so I jumped into their cash reserves, and so they have a lot of cash. Though they were making lots of losses actually for the 5 years prior to February 2019. They were making losses, just losses altogether. But they had cash. Once you have cash, you survive. Remember, profits are not cash. Losses doesn't mean you have no cash, okay? So financial statements should be prepared on a going concern basis unless the company is in liquidation or it has ceased trading, or the directors have no alternative than to place the company into administration. Then we know that the company is doomed to fail or cannot continue into the foreseeable future. So once again, subsequent events we say should include current and expected profit, debt repayment, and then sources of funding. Okay, audit. The directors will confirm to us that the company is solvent. I think we just touched this somewhere. Okay, the directors must prove to us that the company will survive, but they must give us evidence to the auditors. All right. There are key issues we need to consider: uncertainty over future events, the size and complexity of the business, nature of business, and the degree to which it is affected by external factors. Now, subsequent events may render invalid decisions made at the time based on information available at the time. What are we saying here? We may have taken a decision we thought is valid because of the information we had on hand. But when the subsequent event is reviewed, you realize that the decision we made earlier was actually void because the subsequent events has exposed the lapse in the decision or in the information that we had earlier on. So any decision we would have taken is void. If the auditor, based on the information they have received, tells you that the PPE has been, there's no material error over there, but the subsequent event shows that there's been some obsolescence in the assets which has not been disclosed, then the decision we make earlier, we have to go and reverse it. We cannot rely on that information. Okay, so consider some of these key issues. What are indicators of going concern that you should flag, that should give you the heads up for you to look at what to do as an auditor? If there is so much liabilities than assets in the company, this company decided to borrow extra money and the bank said, no, we're not going to give you. It's a red flag. Why are they not getting money for their business? The existing covenants, loan covenants they have, this company has breached. They couldn't pay their interest on time, their principal on time. There's a question mark on their credits. Cash flow issues, they're struggling to raise money. They are over trading, no cash to meet their needs, the operational needs. They are selling fixed assets, but they are not replacing these fixed assets when the company is still surviving. You can be selling all your cars and you are not replacing them. Suppliers are not giving them extra credit, no extra days for them to pay. Their debts, they keep restructuring it because today they default, tomorrow they have to go and restructure it to meet the terms of the debt covenant. And again, they are not able to pay their dues, their debts when due. Okay, these are issues of going concern. Operational indicators of going concern looks at changes in the market and technology, and the company is not able to adapt to these changes. There are some legal regimes which have been passed, some legislative instruments, which is affecting the operations. Key management are leaving, and they are not getting competent guys to fill the gaps. They depend on a few product lines in a depressed market. It's an operational indicator of going concern issues. Key customers are no longer patronizing their services. Suppliers are also not providing them. Key suppliers have curtailed their relationships or are not providing them with credit terms or providing them with raw materials. Products are running obsolete. They are going obsolete. Reputation is in question, is in the balances. There are lots of legal issues hanging on their necks. These are indicators of going concern issues. There are other indicators. Assuming these guys are not complying with the capital or statutory requirements, such as solvency or liquidity covenants to the bank and other financial institutions, that could also smack of going concern issues. There are pending legal and regulatory proceedings against the company. There are changes in laws and regulations which government has passed and could adversely affect the operations of the company. There are some serious catastrophes which may occur. However, the company doesn't have insurance policies to indemnify them in terms of these events should they occur. But remember, the fact that one or two of these indicators have popped up is not sufficient evidence to say that the company is going into solvency. Okay, it's becoming insolvent. Okay, so the fact that it doesn't mean you have to weigh them on their merit, probe further as an auditor, ask questions, get sufficient evidence to support any judgment and claim that you make. Okay, so the fact that a couple of them are happening doesn't mean the company is running dry or going dead. As auditors, once again, whether going concern or subsequent events, we gather sufficient appropriate audit evidence. And any disclosure we make in our books, we must support them. Okay, we must support them with evidence from our side. And of course, any management disclosures should also be supported with evidence from our end, because we would have vouched whatever management is disclosing in their books. We must also test whether or not a material uncertainty exists regarding the use of the term going concern. Okay, regarding the use of the going concern basis. So if management is using a company is operating as a going concern, ask yourself, is there any material uncertainty when those terms are used? Okay, we're wrapping up soon. Once again, carry out enough work, evaluate, not just rely on the statements made by the management, check them. Okay, we should examine any information they've supplied us, check it, assess it. Don't just take it off that, well, they said they are going concern, so we should accept it. No. What basis, upon what basis are they saying that? And apply your professional skepticism, review their cash flows, assess their cash flow forecast, the basis upon which they are forecasting their cash flows, read the director's minutes, the board minutes, the meeting minutes, any other minutes that they have on board. Confirm any evidence of funding arrangements in place with lenders. Get the debt covenants, review it. If you have to speak to the lenders, speak to them. Okay, and then obtain written representations as a first start. Okay, of course, we'll not just accept the written representations, we'll vouch it. Okay, we vouch it. And then incorporates the period. So again, the subsequent event, like we said, incorporates the period from year end to the time we will sign the account. Okay. Okay, I thought I missed one step. All right. Now, the audit review must consider whether the senior auditor, the senior management, and in particular the board of directors, what do they do as part of our review? The board of directors, the senior management, do they have the technical skills, the competency, the know-how to understand the methods they have used in assessing the company's ability as a going concern? So they have made assumptions that the company will survive as a going concern. Do they have the know-how? Do they just write it, or they understand what they have written? Again, the directors must understand whether or not management's assessment has been made in accordance with any applicable reporting framework. Okay, whether it is the IFRS or country-specific GAVs, UK Corporate Governance Code, Companies Act 206. Okay, so check whether they have prepared this, any assessment they have made jives with any applicable laws, regulations, and frameworks. The directors, the senior director, the senior management, do they have the information needed to evaluate how the assessment was made by the management? And are they prepared to question or criticize any approach management has used in making these assessments? Or they just want to rely on their feelings and not on facts? Check that one as well. And how do we do this? You need to speak to them, talk to them, engage them, let them explain some caveats and some processes and approaches, and get documentary evidence to support all of this. Were the board of directors or the senior management involved in overseeing the process of making those assessments? Or they just sat down and somebody did it, they got a consultant who did it and presented the report to them? You would have heard we said material uncertainty regarding this going concern basis. What does it mean? If a going concern basis is appropriate, there is a material uncertainty if and only if the directors, if there's a material uncertainty when directors should describe these uncertainties in the accounts. Once you understand that there are material uncertainties, the directors need to describe this uncertainty in the financial statements. The auditors will always have to include a paragraph to show this material uncertainty in their auditor's report. If care is not taken, they could even include an except for opinion in their audit opinion to cater for this material uncertainty. But it depends. If it is the uncertainty is pervasive, then of course we could end up disclaiming our opinion or issuing an adverse opinion. If no note is included or the auditor disagrees, then we have to modify the report. We can use an except for, usually. If a going concern basis is not appropriate at all, if the basis upon which the management have indicated that this is a going concern, and we realize that the basis upon which they draw those conclusions was not appropriate, adverse opinion, adverse. You tell them clearly that these financial statements do not represent a true and fair view. Now, the effect on auditors' reports, agreements. It is not possible for the auditors to report negatively. We will always, of ongoing concern issues, we must report positively. So, in the past, you would have seen, or you may have read, if you read past, you see there will be a report like, we have nothing. That's a negative statement. We have nothing. That's a negative statement. To report in respect of the director's use of going concern basis of accounting in the preparation of the financial statement. This is no longer appropriate. That negative statement is no longer appropriate. We want you to use what? A positive statement. Take the book, take samples of the auditor's reports. Consider chapter 26, I think so, yes. And you will realize that there are examples of this going concern. And you see the statement has gotten rid of this nothing, this negative statement, now positive reporting. Now again, if the nature of the uncertainty is fully and properly explained so that the auditors consider that the management have made adequate disclosure in the financial statements, the auditors must always include a separate paragraph in the auditor's report, and we must put it under the heading material uncertainty related to going concern. So all the justifications and explanations given to us by management, we are okay with it. Include a caveat in your not a caveat, include a paragraph in your report under the heading material uncertainty related to going concern, and disclose those things over there. Now, this would highlight the role, the note in the financial statement, which discloses the reason for the uncertainty. And it must also state that the uncertainty exists, but that the auditor's report has not been modified or qualified in respect of this material uncertainty. All right, unless there's a disagreement. But if there's a disagreement, so the auditors disagree with the director's approach to the financial statement or their disclosures, and there's a material uncertainty as to whether or not the company is a going concern. What do I do as an auditor? If there's a disagreement, adverse opinion, adverse. Tell them that the financial statements do not represent a true and fair view. Okay, do not represent. Now we must explain the reason why we are issuing this adverse report. Okay, and this should give opportunity to explain the nature of this uncertainty to our shareholders, whom we are responsible to. In rare cases, the auditor may disclaim an opinion. In rare cases, but usually it will be an adverse. Okay, we will look at these opening balances, and if you look at the final review stages, we would have touched a lot of this, so I'm going to jump quickly on this. So ISA 510 talks of initial audit engagement opening balances. ISA 710 talks of comparative information, and we touched on this, or we are going to touch this on the final review stages, okay? So look at what do we do as auditors from previous year. Make sure the financial statement from previous year does not contain any material misstatement. Make sure opening balances jive with the closing balances of previous year. check corresponding accounts, they've clearly classified them and disclosed them. Accounting policies used are consistent. Auditors' reports were not modified. If so, has that been issued? Has been resolved? Okay. So once again, opening balances, comparatives, I will leave this one because you find it in the final review stages. And simply what we are saying is that make sure you review the previous year's accounts, the records, the control procedures, speak to the clients, understand the balances which have been brought forward. If you are the continuing auditor, you did this audit last year, it's so easy for you to continue this year, and so you know how to bring your opening balances forward. But if you are a succeeding auditor, you're a new auditor, then you have to speak to the clients, understand the opening balances, get some working papers from the clients, shadows from the clients, speak to the previous auditor and get copies of their working papers. They will give it to you. They will give it to you, okay? If the evidence of opening position is not satisfactory, you must modify the report. And we've told you that as part of these opening balances and closing balances, if for nothing at all, if you're a new auditor, try to validate the opening balances of the receivables, the payables, and the inventory. Okay, you can add PPE, but those three are quite susceptible to misstatements. Look at comparative information from previous year to this year. Make sure they jive. Make sure they are prepared using consistent accounting policies. Amount presented in prior year jives. Disclose notes, any ones which require adjustment and restatement, make sure they've been stated. Okay, I rushed through the last part because, like I said, you find it in the final review stages of the audit slides. Okay. 2 case studies, slip and slide, and then Pingo Manufacturing, try them, okay? And then there's an SCCA pass question, exam question on page 375, 378 to 379, quite intensive, but try it. If you're able to understand that question, good job. And it's easy to understand once you've read the text, okay? All right, friends, I will leave it here. I think time is fast spent on this side, but it is worth it, okay? Subsequent events and going concern issues are quite important. If the auditor mistakenly signs off and says the company is actually going to survive into the foreseeable future period, and then somebody whom the auditor has proximity, forget about the Bannerman wording. Forget about the Bannerman wording of disclaimer, not wording like marriage, wording in terms of disclaimer. I mean, once there's a proximity, you, the auditor, can find yourself in trouble. I end it here. I'll see you when I see you. Bye for now.